Preparing for a Sun Life financial interview questions and answers interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work at Sun Life Financial? I want to join Sun Life because it combines financial expertise with a meaningful client purpose, helping people achieve lifetime financial security and live healthier lives. I am particularly attracted to its diversified platform across insurance, wealth, and asset management, which creates learning opportunities and business resilience. My analytical and collaborative approach would help me serve clients accurately, improve processes, and make sound decisions. I also value Sun Life's emphasis on integrity, inclusion, and long-term relationships. While answering, connect Sun Life's insurance, wealth, and asset management businesses to your interests, mention its client-focused purpose, and explain how your skills would contribute to long-term financial security. Question 2. What do you know about Sun Life Financial's business? Sun Life is a global financial services company headquartered in Canada, with operations spanning Canada, the United States, Asia, and asset management markets. Its core businesses include insurance, health benefits, retirement and wealth solutions, and investment management through entities such as MFS and SLC Management. The business earns premiums, fees, and investment income while managing long-term liabilities and market risks. That combination makes disciplined capital allocation, risk management, and client trust central to performance. Make sure to cover Sun Life's major business lines, geographic footprint, insurance and wealth offerings, asset management capabilities, and the importance of balancing growth, risk, capital, and customer outcomes. Question 3. How would you explain the difference between life insurance and wealth management? Life insurance primarily protects against financial loss from death, illness, or longevity, while wealth management helps clients accumulate, preserve, and distribute assets. Insurance revenue comes mainly from premiums, investment spreads, and disciplined underwriting, whereas wealth businesses often earn advisory, administration, or management fees. They complement each other because a client may need income protection today and retirement planning tomorrow. At Sun Life, understanding both needs supports deeper relationships and more complete financial solutions. In your answer, distinguish protection from accumulation, explain how each generates revenue, discuss client objectives, and show why both offerings can complement one another within Sun Life's broader financial services model. Question 4. What are the key financial statements, and how do they differ for an insurance company? The three core statements remain the income statement, balance sheet, and cash flow statement, but insurance reporting has distinctive economics. The balance sheet includes substantial invested assets and insurance contract liabilities, including reserves for future claims and benefits. The income statement reflects premiums, investment income, claims, expenses, and changes in liabilities. Cash flow analysis must consider premium receipts and benefit payments. I would also review regulatory capital, because solvency matters alongside accounting profitability. Be sure to mention the income statement, balance sheet, and cash flow statement, then emphasize insurance reserves, invested assets, premiums, claims, policyholder obligations, and the importance of regulatory capital. Question 5. What is an insurance reserve, and why is it important? An insurance reserve is the amount set aside today to meet expected future policyholder benefits and related expenses. Calculating it requires assumptions about mortality, morbidity, longevity, lapses, expenses, interest rates, and investment returns. If experience or assumptions change, reserves may increase or decrease, affecting earnings and capital. I would treat reserve analysis carefully because it combines financial modeling with customer protection. Strong governance, documentation, independent review, and sensitivity analysis are essential. Focus on reserves as estimates of future policyholder obligations, explain assumptions such as mortality, morbidity, lapse, and discount rates, and discuss how reserve changes affect earnings, capital, and trust. Question 6. How do interest rates affect Sun Life's insurance business? Interest rates affect both the value of insurance liabilities and the returns earned on invested assets. Falling rates can increase the present value of long-duration liabilities and reduce future reinvestment income, while rising rates may pressure the market value of bonds but improve reinvestment opportunities. The effect depends on duration matching, product guarantees, hedging, and accounting treatment. I would analyze the asset-liability gap, stress multiple rate scenarios, and distinguish temporary valuation movement from lasting economics. Make sure to discuss asset and liability duration, reinvestment income, discounting, spread compression, mark-to-market effects, and how asset-liability management reduces economic and accounting volatility. Question 7. What is International Financial Reporting Standard 17, and how does it change insurance reporting? International Financial Reporting Standard 17 is the accounting standard for insurance contracts, designed to present insurance results more consistently and transparently. It measures fulfillment cash flows using expected future cash flows, discounting, and a risk adjustment, while the contractual service margin represents unearned profit released as service is provided. Revenue reflects insurance coverage rather than simply cash premiums received. The standard makes assumptions and service patterns more visible, so strong data, controls, actuarial collaboration, and reconciliations are critical. In your answer, explain measurement of insurance contracts, fulfillment cash flows, contractual service margin, insurance revenue, discounting, risk adjustment, and why International Financial Reporting Standard 17 improves comparability and transparency. Question 8. How would you assess the profitability of an insurance product? I would evaluate profitability through projected premiums, claims, expenses, investment income, capital requirements, and the timing of profit emergence. Key assumptions include mortality or morbidity, lapse rates, expenses, inflation, interest rates, and customer behavior. I would calculate metrics such as present value of new business profit, return on capital, and embedded value where relevant. Then I would stress adverse scenarios and compare actual experience with assumptions. A product is attractive only if returns compensate for risk and capital. Cover pricing assumptions, premiums, claims, expenses, persistency, investment income, capital usage, profit emergence, sensitivity testing, and the need to evaluate profitability across the product's entire lifecycle. Question 9. What is asset-liability management in an insurance company? Asset-liability management matches the timing, currency, duration, and risk characteristics of invested assets with expected policyholder obligations. For example, a long-duration annuity portfolio requires assets that can support predictable future benefit payments without excessive reinvestment or liquidity risk. I would monitor duration gaps, convexity, credit quality, liquidity, foreign exchange exposure, and stress results. Is not simply maximizing investment yield, it is earning an appropriate return while preserving the insurer's ability to meet commitments. While answering, define as coordinating assets with liability cash flows, discuss duration, liquidity, credit, currency, and interest rate risks, and explain its role in protecting solvency and policyholder commitments. Question 10. How would you analyze an investment portfolio for Sun Life? I would begin with the portfolio's purpose and liability profile, then assess total return, income, duration, credit quality, concentration, liquidity, currency exposure, and capital usage. I would separate market movements from manager decisions and compare performance with the correct benchmark after fees. Stress testing would examine rates, spreads, defaults, equities, and liquidity needs. I would also review mandate compliance and responsible investment considerations. The conclusion should explain whether returns adequately compensate for risk and support policyholder obligations. Be sure to mention return, risk, duration, credit quality, concentration, liquidity, currency exposure, liability matching, ESG considerations, and how portfolio decisions should align with both mandate and capital constraints. Question 11. What key ratios would you use to evaluate an insurance company? I would review return on equity, operating earnings, new business value, premium growth, expense ratios, claims or benefit ratios, persistency, investment returns, and capital ratios. For a property and casualty business, the combined ratio is especially useful, while life and health products require closer attention to assumptions and reserve movements. I would compare trends with peers and internal targets, then investigate drivers rather than relying on a single metric. Strong growth is valuable only when profitability and capital remain sound. In your answer, discuss profitability, capital strength, claims and expense performance, persistency, growth, investment returns, and liquidity, while explaining why ratios must be interpreted by product, geography, and reporting framework. Question 12. Tell me about a time you found an error in financial analysis or reporting. In a monthly reporting process, I noticed that an expense variance did not reconcile to the supporting schedule. I independently recalculated the totals, traced the difference to a duplicated upload, and confirmed the issue with the preparer before escalating it. We corrected the report before distribution and added a control comparing source system totals with the final file. The experience reinforced that careful review is not about assigning blame. It is about protecting data quality, deadlines, and stakeholder confidence. Make sure to structure the response using situation, task, action, and result. Explain how you validated the issue, communicated professionally, corrected the process, and quantified the outcome where possible. Question 13. Describe a time you had to work with incomplete or inconsistent data. I once analyzed performance data where two systems used different customer and date definitions. I first clarified the business question, documented each field's meaning, and reconciled a sample across systems. Where information remained unavailable, I used a conservative assumption, ran sensitivity cases, and clearly labeled the limitation. I presented both the recommendation and its confidence level, then proposed a data standardization fix. That approach allowed the team to act while preserving transparency about what the analysis could and could not prove. Focus on defining the decision needed, identifying data limitations, reconciling sources, using reasonable assumptions, documenting uncertainty, and communicating how limitations affected your recommendation. Question 14. How would you handle a conflict with a colleague or business partner? I would address the disagreement directly and privately, beginning by understanding the other person's objectives and concerns. Then I would separate factual differences from judgment calls, review the relevant data or policy, and identify the shared outcome. If multiple options existed, I would compare their risks, costs, and timing rather than arguing preferences. I would document the agreed approach and escalate only if the issue affected compliance, material reporting, or remained unresolved after a good faith discussion. Be sure to mention listening first, separating facts from opinions, returning to objectives and evidence, proposing practical alternatives, documenting decisions, and escalating only when necessary. Question 15. How do you prioritize competing deadlines? I rank work by impact, deadline rigidity, risk, and dependencies. A regulatory submission or client-impacting issue would generally outrank a routine analysis, while tasks requiring another team's input need early coordination. I break important work into checkpoints, confirm priorities with my manager when conflicts arise, and communicate realistic timing before a deadline is missed. I also protect review time because rushing financial information can create larger downstream costs than a modestly delayed low-risk task. In your answer, explain how you assess regulatory, client, financial, and operational impact, clarify dependencies, communicate trade-offs early, and maintain accuracy instead of merely completing tasks fastest. Question 16. What does good risk management look like at a financial institution? Good risk management means identifying exposures early, measuring them against clear risk appetite, applying effective controls, and escalating exceptions promptly. At a financial institution, that includes insurance, market, credit, liquidity, operational, cyber, regulatory, and reputational risks. I would expect clear ownership, independent challenge, documented procedures, stress testing, and continuous monitoring. The goal is not eliminating every risk. It is taking informed risks that support strategy while protecting clients, capital, data, and the firm's long-term credibility. Cover identification, measurement, mitigation, monitoring, controls, governance, risk appetite, escalation, and culture, with examples spanning insurance, investment, operational, regulatory, cyber, and reputational risks. Question 17. How would you respond if you were asked to bypass a control to meet a deadline? I would first understand why the control exists and whether an approved alternative could meet the deadline. I would not bypass it informally, particularly if it protects financial reporting, client assets, privacy, or regulatory compliance. I would explain the risk respectfully, involve the control owner or manager, and document any authorized exception, compensating review, and follow-up remediation. Meeting a deadline matters, but an undocumented override can create greater financial, legal, and reputational consequences for Sun Life. While answering, emphasize integrity, understanding the control's purpose, assessing materiality, proposing compliant alternatives, documenting the decision, and escalating appropriately without becoming confrontational. Question 18. What is the difference between revenue, profit, and cash flow in an insurance business? Revenue reflects insurance services, premiums recognized under the applicable accounting model, management fees, and other operating income. Profit subtracts claims, benefits, expenses, financing effects, taxes, and changes in insurance liabilities from recognized income. Cash flow tracks actual receipts and payments, which can differ materially because premiums may be collected before benefits are paid and non-cash reserve changes affect profit. I would analyze all three together. Revenue shows scale, profit shows accounting performance, and cash supports liquidity. Make sure to distinguish premiums or fee revenue from accounting profit and cash movement, explain reserve and investment effects, and show why all three measures provide different but complementary views of performance. Question 19. How would you use Excel or data tools in this role? I use Excel to structure data, reconcile balances, build pivot summaries, perform lookups, and create scenario analyses. For larger or recurring datasets, I use Power Query or similar tools to standardize inputs and reduce manual handling. I validate formulas with independent checks, preserve source data, document assumptions, and maintain a clear audit trail. The tool is only part of the solution. I also translate outputs into a concise business explanation so stakeholders understand the decision and its limitations. Discuss practical skills such as reconciliations, pivots, lookups, Power Query, charts, and scenario analysis, while emphasizing validation, audit trails, access controls, and communicating insights clearly. Question 20. What questions would you ask us at the end of a Sun Life interview? I would ask how success is measured during the first 6 to 12 months, which priorities are most important for the team, and how this role interacts with actuarial, finance, investments, technology, and business stakeholders. I would also ask what challenges the team is currently solving and how Sun Life supports professional development. Finally, I might ask what distinguishes high performers in this position. Those questions help me understand expectations and show that I am focused on contributing quickly. Be sure to ask about success measures, team responsibilities, current priorities, development, collaboration, and the role's largest challenges, demonstrating preparation without asking questions answered directly on the company's website. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.